Right. Yes. So let's carry on um, with this. So we have the what we have, if you like. Yes. So far, we have looked at consideration. I highlighted this matter, this business of fair value, IFRS 13. Yes, advice, and this is again I keep highlighting throughout the course. It's about fair value. Now, it's unfair, right, that you go into a business. So so far we've talked about, if you like, the goodwill, making sure that's at fair value. But the question here is now, what about, because remember it's goodwill less the net assets at acquisition. Let's focus in. That's the issue now here. The argument here now is these net assets at acquisition, are they at fair value? So IFRS 3 revised requires that subsidiaries' assets and liabilities are recorded at their fair value for the purposes of calculation of goodwill and production of consolidated. So adjustments will therefore be made where they do not reflect fair value. So that's what we're trying to do here. So because this sits in working two, right? Because this is about the subsidiary, we have to bring the net assets to fair value at the acquisition date. And of course, because they're now at fair value, within consolidation, um, they will undergo, as you can imagine, if you're fair valuing physical assets like buildings, they will undergo depreciation from one year to the next, or they might undergo some impairment of sorts. But we must also recognize that fall in value because in working two, right? Because working two is at acquisition and at reporting. I mean, I'm really just doing double entry, right? At the beginning of a year, you're recognizing assets, and then you recognize depreciation as a fall. So in any normal accounting process, if depreciation was over 5 years, at the beginning of the year you'll have 100. If it's over 5 years, you're taking it at the end of the year you'll have 80. That's all I'm doing. I'm literally telling you that these assets, even though you've revalued them, still fall in value. Nothing special. So really, net assets at acquisition, here we are. Net assets at year end, here we are. So that's what we're doing. Those are the two things we're trying to make sure we implement, not just recognizing them at fair value, but also recognizing their their value, their new value at the end of the period. So what is it telling us? Adjust working to bring in the fair. And when it says adjust working to, it is a double entry. Remember, this is a subsidiary. It's telling us go along and update the subsidiary. So if there's debit asset, credit equity. This is the bit we're seeing all the time. This is the bit above what we don't see in working two, but it is working two. It's there. Those assets are there. They're just above. We're just not seeing them, right? Because we want to get this up to fair value before we merge. This will ensure that fair value of the net assets are carried through to goodwill and the non-controlling interest. So, I mean, we're going to do the workbook separately, but I'm going to give you the workbook to do for homework. But the workbook is very clear. We're going to see it, and you can see some real examples here. But what I do with these lectures is to go through the text, Just you have that as a second resource. Let's look at TYU4. So let's look at TYU4, and let's go there. So TYU4 is peppermint and spearmint. And I want to focus on working two. I'm not going to do the whole thing, and you will please finish this. But it's important. What's imperative that you understand these new adjustments. My issue is trying to get spearmint, make things fair for spearmint. We'll revise working three, which is the goodwill. But I want to talk about first of all what's going on with the fair value update on spearmint. So all this business up here is asking you to do some work on consideration, if you like, which you should be able to do. So please have a go as revision. But then let's look at let's write out the situation for Spearmint. Spearmint has equity of 500, retained earnings of 300. Well, we'll see. We'll work. Let's write out working two. 500, 300. If you like, 500 and 300. That's the closing. This is the year end. So the reporting period. We'll find out So here we are, working to net assets oops, sorry, I do this here, working to net assets at acquisition, net assets at reporting. I know your share capital is 500. I know your retained earnings are 300. So share cap, retained earnings. So I know this is 800 right now. At least I know that. I know this is always going to be 500. Let's go back and see what the retained earnings were at acquisition. You'll be given this in the exam. At acquisition, the fair value of this, we'll come back to this. At the date of acquisition, the non-controlling interest was this, the consolidated goodwill. Sorry, let me see where they would have told this to us. Yes, 80% 2 years ago when the reserve stood at 125. So if I come back here to my question, I'm told that this was 125 at the beginning. That's what I'm told. So this is these are the physical assets I can see. This is the net, this is the value of the physical assets that we see. But we are told, I'm just going to change my pen color, we are told that this is not the fair value. We're told, so up here I have A minus L, right? You can see it in here anyway. So it's not like I'm making it up. You can clearly see where I'm going here. You can see the assets and liabilities here, and A minus L will add up to that equity figure. But I am told, if you like, that as we go along, that here you can see that at acquisition, the fair value of Spearmint's plant exceeded its book value by 200,000. So, first of all, I have to update that, and with a journal, and if you like, so debit the asset here, 200, credit some revaluation, 200. That's the first thing. So for all consolidation, we always deal in fair value. I'm also told, if we go back again, that it says here that for many years you'd been selling some products that are brand name. At the date of acquisition, the directors valued this brand at 250,000. So I'm also told that you have an intangible asset, so that it's been lying dormant and it's now come alive. So I have intangible 250 up here, and I also have intangible evaluation, intangible 250. Pure double entry, nothing special. That's what I have. Now, like I said, these things fall in value from one year to the next. So if you see a workbook might do something like this. It might write 200 and write the corresponding depreciation. This will say 250 and write the corresponding depreciation underneath. I just like to deduct the two and just sort of, because it's all about value ultimately, right? And we're told that the building was going to last for 5 years. So you've done 2 years because it says that, right, it's 200 over 5. If you like, so that's 40, depreciation of 40 each year. If you were putting through this through the income statement, you would debit expense, which is what we would see in the statement of profit or loss, expense of 40 twice, because it's 2 years that we're talking about, and you would credit, if you like, the asset up here in effect. So you would have this, basically this coming off the asset credit of 80, wouldn't you? So credit 80 here and debit the expense of 80, which is what we're doing here, really. We're removing this. This is coming through the income statement, so to speak, and coming off. So we have 80 coming off here, and I believe this was over 10 years. We'll check in a second. So 10 years, so 2 years of that is 50, so you have 50 coming off there. And then we can now add things through. I mean, of course, you can carry on. They tell us there's well, at least we know, well, you can carry on, of course, but the key point here is that over here, now you have the fair value of this business here, because we've brought in everything. So when we do what we did in the earlier question by finding the correct consideration based on all this earlier business of, because in the first part of the question they tell us that, oh, hey guys, by the way, you've paid an initial consideration of 1 million. You've issued shares at this at £1.80 with you just issued shares. So this is a good question. You've not even kind of you've not done any type of what's the word? You haven't done any here. What you've done is we can do it right now. There's nothing there. What you've done is it says that you've paid initial consideration of 1 million. Thank you very much. You've also issued shares, 200,000 shares in your business, and the market value is 1.8. So that's 200,000 times 1.8. Thank you very much. And you've also decided to pay 500,000 in 3 years. But they tell us we now know from experience it's actually 0.75 times this will be the present value. So 500 times 0.75, which is equal to 300 and 500 0.75, which is equal to 375,000. So the full consideration is 1 million plus 3.6 million, which is the 200,000 times the shares. Those shares are worth 3.6 million plus 375,000. That's the full consideration. So now I have my full consideration, which is all of this, right? Add all this together. That's my full consideration for the 80%. And they tell us the fair value. We know what we now do is we take the fair value of the non-controlling interest, which is the remaining 20%, add that through together, and you get the full consideration for the business. And then we can take what we've just been working on, which is working 2 over here, this thing here, which is 500 plus 125 plus all of it, plus the 200 plus the 250 to work out goodwill at acquisition. Remember, this is all happening at acquisition. So this is the value of the business at acquisition, the fair value of the business at acquisition, and we take it away from the fair value of what's been paid for it to find out what the goodwill is. Right? Good. So I think that's and let's just complete that so you can see where we're going. It's just, I mean, we will go through the workbook. There's just so much of it. But please, when I say so much of it, in terms of tying up. So here we have 1075. That's, if you like, the net assets at fair value of the net assets at acquisition, 1075. And we can take this 1075 away from this. I'll just write the 1075 up here. Let me just 1 million. Let's just add this 1 million plus 3600 plus 375. This is 4975. So we have 4975 less this 009. 3,900 is your goodwill. And then from there on we just carry on by impairing it with whatever we're told we've impaired it. Right, good. And I hope this is kind of settling. I hope you're kind of seeing where I'm going. I'm trying my best to kind of look at the detail of the theory as opposed to just to show you why things are actually happening. When we go through the workbook, I'll just walk through the questions on the assumption that you're happy with the thinking or the theory. With this section, what I've been trying to do is to find the fair value of the net assets at acquisition, working 2. That's my main aim. Fair value of net assets at acquisition. That was my main aim. And then, of course, goodwill, the consideration I did in the earlier video. So find that and then subtract the 2, right? But of course, also highlight the fact that I have to carry forward any depreciation that's happened over the year for my newly valued assets. Cool, great stuff. See you in the next video.